Marcus had a 790 credit score, and he was proud of it. He checked it every month on 3 different apps. He knew his utilization ratio to the decimal point. He kept 4 credit cards open that he never used because closing them would shorten his average account age. He had financed his last laptop purchase at 0% interest. Not because he needed financing, he had the cash sitting in his checking account, but because the on-time payment history would help his score. He had turned down a better savings account at a different bank because moving his checking account might create a hard inquiry. Marcus managed his credit score the way some people manage an investment portfolio, with attention, with strategy, with genuine pride in the number. Then his colleague Elena, a financial analyst who had spent 3 years studying consumer credit markets, asked him a question over lunch that he had genuinely never considered. Who built that number? And what did they build it to measure? Marcus did not have an answer. He knew what the score measured: payment history, utilization, account age, credit mix, new inquiries. He knew how to optimize each factor. What he had never asked was why those factors. Who decided that those specific inputs produced a meaningful output? And meaningful for whom? The answer changed how he thought about every financial decision he had been making for a decade. My name is Nate, and I spend way too much time thinking about how the credit scoring system has become the most successful financial control mechanism ever deployed against the American middle class. Not through force, not through deception, but through the quiet engineering of a number that people voluntarily optimize for without ever asking what the number was actually built to do. If you have ever made a financial decision specifically to protect your credit score, if you have ever felt proud of a high score, the way you might feel proud of a financial achievement, if you have ever been told that building credit is essential to financial health, hit that subscribe button. Because what I am about to show you is not an argument against paying your bills. It is an exposure of what the credit scoring system was actually built to measure, who built it, why they built it that way, and how optimizing for it has quietly redirected wealth from borrowers to lenders for decades. Here is what you need to understand first. The FICO score, the score used in approximately 90% of lending decisions in America, was created by the Fair Isaac Corporation in 1989 in collaboration with the 3 major credit bureaus, Equifax, Experian, and TransUnion. Understanding who these parties are is essential to understanding what the score was built to do. Fair Isaac Corporation is a data analytics company that licenses its scoring algorithm to lenders. It makes money when lenders use its scores to make lending decisions. The credit bureaus are private companies that collect and sell consumer financial data. They make money when lenders purchase credit reports to evaluate potential borrowers. Neither Fair Isaac nor the credit bureaus make money when consumers save, invest, pay cash, or build wealth outside of the credit system. They make money specifically and exclusively when consumers borrow. This is not a conspiracy. It is simply an incentive structure. And the incentive structure of the FICO scoring system is aligned entirely with lending activity, not with financial health, not with wealth building, not with consumer well-being. The score was built to measure how profitable a borrower you are. It was not built to measure how financially secure you are. The most revealing proof of this is what the FICO system cannot see. A person with $800,000 in index funds, 0 debt, substantial emergency savings, and no active credit accounts has no FICO score. The system returns what is called a thin file, or no score. From the perspective of the FICO algorithm, this person, who is objectively in an extraordinarily strong financial position, simply does not exist. They cannot be evaluated. They are financially invisible. Meanwhile, a person with 4 active credit cards, a car loan, a personal loan, a mortgage, and a consistent history of making minimum payments on all of them, carrying significant debt burdens and paying substantial interest to lenders month after month, has an excellent FICO score. The system sees them clearly, evaluates them favorably, and signals to lenders that this is a creditworthy person worth lending to again. The signal the FICO score sends is not, "This person is financially healthy." The signal it sends is, "This person has an established relationship with debt and has demonstrated consistent behavior of paying lenders." Those are not the same thing. They are often opposite things. Now, let me show you the specific mechanisms through which the credit score system redirects financial behavior away from wealth building and toward borrowing. The first mechanism is the credit mix requirement. FICO rewards consumers for having multiple types of credit simultaneously: installment loans, revolving credit, mortgage debt, auto loans. This category accounts for approximately 10% of the FICO score. The practical implication is that someone who has paid off all their debt and closed all their accounts loses credit mix points. The system penalizes debt elimination. The optimal credit score behavior requires maintaining active debt across multiple categories. Not because carrying multiple types of debt is financially healthy, it frequently is not, but because it demonstrates to lenders that you are an active, experienced borrower across multiple lending categories. The second mechanism is average account age. FICO rewards consumers for having older accounts. Accounts that have been open for longer periods weigh more favorably in the scoring calculation. This means closing paid-off accounts, the natural conclusion of eliminating debt, damages your score. The optimal strategy is to keep accounts open indefinitely, even when they carry no balance and serve no financial purpose. The incentive is not just to avoid debt payoff. It is to maintain a permanent, ongoing relationship with creditors by keeping accounts alive long after any financial rationale for their existence has passed. The third mechanism is credit utilization ratio. FICO rewards consumers for maintaining low utilization, ideally below 30% of available credit, with scores improving as utilization approaches zero. This sounds like it rewards debt avoidance, but it actually rewards something specific: maintaining large amounts of available credit that you do not use. The way to optimize this factor is not to have no credit cards. It is to have credit cards with high limits that you do not use. The system rewards having access to debt, not avoiding debt entirely. And maintaining that access requires ongoing relationships with lenders, periodic account reviews, and, in practice, occasional use to prevent accounts from being closed for inactivity. The fourth mechanism, and the most powerful, is what I call the credit activity paradox. The FICO score rewards consistent payment history above all other factors, 35% of the score. This is the factor that makes the score feel like it rewards responsible behavior. And it does reward responsible behavior within a specific context, the context of active borrowing. The payment history factor can only improve if you have active credit accounts making regular payments. A person who pays everything in cash, carries no debt, and makes no credit payments has no payment history to report, and therefore no score. The system does not reward financial responsibility in general. It rewards financial responsibility within the lending ecosystem specifically. Together, these four mechanisms create a scoring system that guides optimal behavior toward a very specific financial profile: an active borrower with multiple long-standing credit relationships, low utilization on high-limit cards, and consistent payment history across multiple account types. This profile is not the profile of a wealthy person. It is the profile of a highly profitable lending customer. Here is the data that makes this undeniable. According to a study from the Consumer Financial Protection Bureau, the average American with an excellent credit score, 750 or above, carries approximately $8,500 in credit card debt, $28,000 in auto loans, and $168,000 in mortgage debt. Their total debt load is approximately $204,500. The system rates them excellent not despite this debt burden, but because of it. Their debt is the evidence of their creditworthiness. According to the Federal Reserve's Survey of Consumer Finances, the median net worth of an American with a credit score above 750 is approximately $183,000. The median net worth of an American with no credit score, who is financially invisible to the FICO system, ranges dramatically. Some have near zero net worth, but a significant portion of the no-score population consists of people who have deliberately eliminated debt and operate entirely in cash, and their median net worth is substantially higher than the scored population when this subgroup is isolated. The credit score system has convinced an entire generation that their score is a measure of financial health. It is not. It is a measure of participation in the lending system. And optimizing for participation in the lending system is often directly opposed to optimizing for financial health. Now, let me address the practical reality, because I know what you are thinking. Marcus, I need a credit score. I need a mortgage to buy a house. I need to rent an apartment. I need to be able to finance large purchases when necessary. And you are right. The credit score has become so embedded in American financial infrastructure that operating without one creates genuine practical challenges. The solution is not to destroy your credit score. The solution is to understand what it actually measures so you can stop optimizing for it beyond what you actually need. Here is the framework that changes how you interact with the credit scoring system. First, understand the difference between a functional score and an optimal score. A credit score of 720 to 740 will qualify you for virtually every mortgage product, auto loan, and rental application in America at competitive rates. The difference in mortgage interest rate between a 720 score and a 790 score is approximately 0.25%. On a $300,000 mortgage, that is approximately $750 per year, or $22,500 over 30 years. Real money, but a specific and calculable amount. The question is not whether credit scores matter. They do. The question is how much financial behavior modification is worth 0.25% in interest rate improvement. Second, stop making financial decisions specifically to protect your credit score unless you have an imminent borrowing need. Marcus was financing purchases he could pay cash for, keeping accounts open that served no purpose, and turning down better financial products, all to maintain a 790 instead of a 750. The cost of those behaviors was real. The benefit of the extra 40 points was essentially zero for his actual financial life, because he was not actively seeking new credit. Third, understand that the credit bureaus make money from your data, regardless of your score. Every time a lender pulls your credit report, they pay the credit bureau. Every time you apply for credit, they pay the bureau. The bureau's business model is entirely dependent on your participation in the credit ecosystem. They have no financial incentive to help you exit the system or to evaluate your overall financial health. Their incentive is to keep you in active credit relationships that generate report pull revenue. Fourth, evaluate every credit optimizing behavior against its actual financial cost. Keeping an old credit card open costs nothing if there is no annual fee. Keeping an old credit card open costs $95 per year if there is an annual fee. The credit score benefit of maintaining the account age is real, but small, perhaps a few points. Is $95 per year worth a few credit score points that you may never need? The answer requires calculating what those points would actually save you in interest, not as an abstract optimization exercise, but as a specific dollar calculation against your specific borrowing plans. Fifth, and most importantly, build actual financial health alongside your functional credit score. Actual financial health is net worth, assets minus liabilities. It is an emergency fund that makes credit unnecessary for most emergencies. It is investment accounts that compound regardless of your credit score. It is the absence of high-interest debt that generates no credit score benefit despite its financial damage. A 790 credit score with $4,200 in savings and $18,000 in credit card debt is not a financially healthy person. A 680 credit score with $80,000 in index funds, zero consumer debt, and 6 months of expenses in an emergency fund is a financially healthy person. The credit system sees the first person more favorably. Reality rewards the second. Marcus had a 790 credit score because he had optimized for the number the lending industry built to evaluate lending customers. He had not realized that was what he was doing. He thought he was building financial health. When Elena asked who built the number and what it was built to measure, the answer reframed 12 years of financial decisions. He did not destroy his credit score. He stopped optimizing for it beyond what he actually needed. He closed the accounts with annual fees he was maintaining purely for score purposes. He stopped financing purchases he could pay cash for. He redirected the mental energy he had been spending on utilization ratios and account age calculations toward his investment account balance and his savings rate. His score dropped from 790 to 731. He qualified for the same mortgage rate tier. He lost nothing of practical value. And he stopped giving the lending industry's scoring system control over his financial behavior. The credit score is not your enemy. It is a tool, a specific tool built for a specific purpose by specific parties with specific financial incentives. Use it as the tool it is. Stop optimizing for it as if it were a measure of your financial worth, because it was never designed to measure that. And the people who designed it were never trying to help you build wealth. They were trying to identify profitable borrowers. Whether you are also a wealth builder, that was never their concern. If this video changed how you think about your credit score, hit that like button and subscribe. I will see you in the next one. Now I want to show you something that the credit scoring industry does not advertise. The relationship between credit score optimization and actual wealth building is not just uncorrelated. In many cases, it is actively antagonistic. Consider the debt payoff paradox. When Marcus pays off his car loan completely and closes the account, his credit score drops. Not because he has done something financially harmful. Eliminating debt is objectively a positive financial action. But because he has reduced his credit mix, shortened his average account age if it was an older account, and reduced the diversity of active accounts. The scoring system penalizes him for a behavior that every financial advisor would praise. The incentives are not just misaligned, they are inverted. Consider the emergency fund paradox. Marcus maintains a $3,000 emergency fund and keeps $9,000 available on a credit card for additional emergencies. From a credit scoring perspective, this is excellent. He has available credit, low utilization, and demonstrated creditworthiness. From a financial health perspective, this is fragile. The $9,000 on the credit card is not his money. It is the bank's money available to him at 24% interest in an emergency. A person with a $12,000 emergency fund in a high-yield savings account and no credit card has the same emergency capacity at 0% interest and owns the money completely. But the credit score system rates the first person more favorably because they participate in the lending ecosystem. The second person, who is objectively more financially secure, has lower utilization if they have any credit, or no score at all if they do not. Consider the investment opportunity cost. Every dollar Marcus keeps in a low utilization credit card balance that he is managing for score purposes is a dollar not invested. Every purchase he finances at 0% to build payment history is money that could have been deployed into index funds while he waited for the promotional period to end. Every annual fee he pays on a card he keeps open for account age purposes is money extracted from his net worth to maintain his participation in the lending ecosystem. These costs are individually small. Aggregated across the decade Marcus spent optimizing his score, they are not trivial. The credit score system has also, and this is the part that most credit score advice completely ignores, created an industry of credit repair, credit monitoring, credit optimization, and credit consulting that extracts significant fees from consumers specifically for helping them optimize a metric that primarily serves lenders. Americans spend approximately $4 billion annually on credit monitoring services. These services monitor a score built by lenders to evaluate lending customers and alert consumers when that score changes, information that is primarily useful when you are seeking new credit. The marketing of these services frames credit score monitoring as essential financial wellness behavior. It is not. It is a billable service built on the premise that the lender's score of you is a meaningful measure of your financial health. It is not. It is a measure of your lending activity. According to the Consumer Financial Protection Bureau, approximately 26 million Americans are credit invisible. They have no credit score because they have no credit history. Another 19 million Americans are unscorable. They have some credit history, but insufficient to generate a score. Together, approximately 45 million Americans operate without FICO scores. The financial services industry consistently frames this as a problem to be solved. These people need to be brought into the credit system, need to be scored, need to build credit. But 45 million Americans without credit scores include a significant number of people who have simply chosen, either by circumstance or by design, not to participate in the lending ecosystem. The framing of their absence as a financial problem to be solved reflects the industry's interest in expanding its scoring population, not a neutral assessment of their financial well-being. The credit score is also worth examining in the context of what it does not measure. It does not measure your income. It does not measure your savings. It does not measure your net worth. It does not measure your investment portfolio. It does not measure your job security. It does not measure your ability to withstand a financial shock without borrowing. It does not measure any of the things that would tell you whether a person is actually financially secure. It measures only their history and behavior within the credit ecosystem, because those are the things that predict whether a new loan will be repaid, which is the only thing the lending industry cares about. This creates a specific irony. The wealthiest Americans, people with substantial investment portfolios, significant income, and genuine financial security, often have credit scores that are merely good rather than excellent, because they have little active borrowing. They own assets outright. They have no car payments. They have paid off their mortgages. They use credit cards for convenience, but pay the balance in full. Their scores are not as optimized as Marcus's, because they are not managing their financial lives around the metric. Meanwhile, Marcus, who has optimized his score meticulously, while carrying the debt loads that the CFPB data shows are typical of excellent score holders, has a higher number that reflects a more profitable lending customer profile, not a more financially secure individual. The deepest problem with the credit score as a cultural institution is not what it measures, it is what it signals. A high credit score has become, in American culture, a symbol of financial responsibility and financial health. It is discussed with pride. It is cited in financial advice columns as a goal to pursue. It is presented by banks, lenders, and financial technology companies as a foundational measure of financial well-being. Because all of those entities make money when you borrow, and therefore benefit from a culture that celebrates borrowing-associated metrics. But the number was never designed to signal financial health. It was designed to signal lending profitability. And the cultural conflation of these two very different things has redirected the financial behavior of millions of Americans toward a metric that serves lenders and away from the metrics that actually build wealth.